So, real estate deal analysis, crunching the numbers. So I'm going to set a couple parameters for what we're going to talk about here to make sure that we're all on the same page. So what we're going to talk about is assessing cash flow analysis for buy and hold real estate. Does it cash flow? We know that the golden rule of real estate investing is that cash flow is king, and that if you have a negative cash flowing property, it's going to seriously hinder you from approaching the next investment. So this is classic buy and hold real estate and the analysis that we're looking at. Now, we're also going to look at it through the lens of production of cash flow in terms of yield. We're also going to look at the production of return on investment, which is basically determined by equity growth, mortgage paydown, etc. We're going to get into all of that stuff. Now, for those of you who are members of different investment groups, you know, there's so many great tools out there. So if you're a paying member of RAIN, they've got an analysis module built into their members only section of their website. If you're a KeySpire member, they've got kind of a one-page analysis spreadsheet that they use for their pro formas. If you start networking with people, a lot of people like building their own analysis spreadsheet so that they can look at the numbers in the way that they want to look at them. So this is our in-house Mogul analysis spreadsheet. If you want a copy of this spreadsheet, it's free for everybody. We don't hide it. We don't guard it. It's just a piece of content that we love sharing with people because it's so valuable. So if you want it, just put your email in the chat window. And we're going to do a tutorial on how to use it. It's very, very simple and elegant and easy to use. And we do that on purpose because, you know, analyzing deals should be quick, not complicated. All right. So let's start from the back and work our way forward. So when we look at the presentation slide, this is the pro forma. You've probably seen this included in some of the pro formas we've mailed out from Mogul. So let's review the different pieces of this and talk about what they mean so that we know what we're looking at. The purchase price goes in here. That's pretty obvious. We have 20% down because for investment properties, you need to put at least 20% down. You can only put less than 20 if you're living in it as a primary residence. So we don't really count on that. We've got the legal right here. Looks like somebody's put in the legal at 15 bucks. That's not right. We'll have to add a couple of zeros there. Inspection, we can put in the cost of your inspection. And then contingency fund. So that's the first question we often get is, what is this contingency fund all about? Well, contingencies are just that. Things don't always go according to plan. Sometimes you need to do some initial maintenance. Sometimes you have to float the property for a month or two with your initial vacancy. So we always recommend putting some money into a savings fund specifically for that. You really get your joint venture off on the wrong foot if you start with a cash call a couple of months in because you didn't have a contingency fund. So that's highly, highly recommended that you have some cash put aside because the first year you own the property, often stuff will come up that you have to deal with. So we have our total investment right here. Next, we've got our mortgage terms. So we got our rate, amortization, term, and then the type. Are we looking at a variable or a fixed? So we got our payment right here. Now, cash flow is basically just profit. Are you making money every month or are you not making money every month? Therefore, we actually call this the profit section. Now, any business is just a simple calculation of revenue subtracting expense. Easy peasy. So one of the things that we do, because this is a very common way to manage properties in Edmonton, is that you actually include the utilities with the rent. So that's why in the fine print here it says utilities included in the rental amount. Now, this specific version of the spreadsheet is meant for basement suite houses. So we put in our upper suite rent, put in our lower suite rent, and then if you choose to rent the garage separately, which by the way, we can and do in Edmonton, put the garage rent right there. So what does that get you? Well, it gets you your total monthly revenue or rent, and then we annualize it as well. Now, for real estate, there are some expenses that you have to take into account. So we got our expense section. So expense number one, property tax. Okay, we can get that off the MLS listing. Or you can go onto the City of Edmonton website and get it as well. Insurance, got to pay that, can't avoid it. Property management. We always include 10% property management as an expense line on our property. There are some people out there that Do not include it and say, well, it'll cash flow if you self-manage. My personal perspective is that real estate's a business, delegation is important, and the only way you can scale is if you actually hire property management at some point. So we always put the property management in because I personally believe that if a property doesn't profit with property management, the deal's too skinny. And if you happen to self-manage, well, that's bonus money for you, but know that that is a factor for the property that you typically have to take into account one way or the other. Next, utilities. So we put our utilities amount in because remember the utilities are included for the rent. So the tenants do pay the utilities because it's included in the rent, and then it comes out as an expense line. Now here's where we add to the contingency fund. So this is super duper duper important because this is a way that some people will choose to fudge their cash flow numbers. We recommend saving 5% for vacancy, and then for brand new properties, we recommend saving 2% for repairs and maintenance. For older properties, it could be 5 to 8%. So again, this money gets squirreled away and added to the reserve fund for contingencies, be it covering floating a vacancy or repairing after a tenant on a turnover or fixing something that breaks. And then we've got our mortgage right here. So what do we got? We got our revenue minus our expense equals our cash flow. So this is what I like to call the true cash flow because it doesn't take into account the reserve fund. The reserve fund technically is supposed to get spent at some point or another, even though it accumulates over time. However, in order to be able to compare apples to apples, we also put the reserve fund contribution in right here. So you can see that's vacancy plus repairs is $159. That's the reserve fund right here. So we do count it as profit because it technically doesn't get spent on the spot in the same way that tax, insurance, management, utilities, those get spent on the spot every month. Utilities or vacancy and repairs accumulates in the reserve fund. So some people like to be a little more cowboy about their investing and they do not put this money into a reserve fund. They just count it as part of their cash flow. Or for people that are buying newer properties that have low vacancy, that money just accumulates in the reserve fund, and when you exit in 5 to 10 years, it actually didn't get spent. And so people want to know, like, okay, how much am I saving in that reserve fund? So we've got true cash flow, reserve fund savings that goes into your savings fund, and total profit. And those are kind of our three numbers right there. Now, if you are the kind of person that wants to put money in your pocket every single month and use that cash flow to support your lifestyle and income, this is the amount that we'd recommend taking off of the property. We would recommend putting the rest into a savings fund. Now, if everything goes swimmingly with your property and you never, ever, ever spend it, great. It does in fact produce return on investment because you get to keep that money at the end of the project. But it's better to have it put aside and not spend it than need it and not have it put aside, if that makes sense. So that's the initial breeze through of the cash flow portion of the spreadsheet. This is the ROI projection we're going to get here in just a second. Next, we want to talk first about cash on cash yield. Now, cash on cash yield is a very, very important number because it allows you to actually line properties up and compare them accurately one to the other. What do I mean by that? Well, if you have a $1 million property that only profits $100 a month, that's a very low yield. But if you have a $1 million property that produces, say, $1,000 a month, and a $500,000 property that produces $1,000 a month, if you're looking at the cash flow, they're like, oh, it's $1,000 a month in cash flow. But you actually need to buy twice as much property. You need to spend twice as much money to earn that cash flow in the $1 million scenario. So the yield, the best way to think about it is like a pound per pound percentage of how much of that property's value converts into cash flow. And that allows you to compare a $500,000 property to a $750,000 property to $1 million property accurately across the board because the yield is the equalizer. So we calculate the yield by taking the annual profit and dividing it by the amount invested. And that spits out your yield number. So again, if you invested $100,000 in a, let's be boring, in a GIC at 2%, it yields, that $1 million creates 2% or $2,000 per year in profit. If you invest $73,000 into this real estate deal that $73,000 will produce or yield for you 3.88 of true cash flow and 6.7 of total profit. That's what yield is all about. Okay, so we've got our yield figured out. Let's talk about our return on investment projection. So when we talk about return on investment, Keyspire has, I think, trademarked the phrase 4 ways to win. I think Rain has a couple of different ways of explaining it. But basically, when you buy real estate, there's 3 main ways that you're making money in buy and hold real estate. Number 1, you've got your cash flow yield. But number 2 is a portion of this payment actually converts into principal paydown, which means you're paying down the debt of the mortgage. So you owe less money to the bank when you exit, which means you have more money that you get to keep. That money you keep is a return on your investment. The third stream of income is the market appreciating. So this property we buy for $339, we're hoping that when we go to sell it in a few years, maybe it's worth $380, maybe it's worth $400, whatever. So there's a couple of factors that we need to take into account. We put in market growth, and because Edmonton is such a slow-growing market, we put in a really conservative number like 2%. For those of you who are from Vancouver, you might want to put in 5 to 8%. Victoria, 4 to 8%. Kelowna, 5 to 6%. Like that's the growth number should reflect your market. We are super conservative in Edmonton with 2%. We're also conservative with rental inflation at 2%. Now, cumulative equity gain basically takes those 3 items and adds them up. So how much mortgage did we pay down, plus how much cash flow did we earn over a 5-year period, plus how much market appreciation did we get. We take those 3 pieces, we add them up into a grand total, and that's our cumulative